The Corporate Transparency Act was designed to crack down on bad actors who would use U.S. businesses to conduct illegal activity. It goes into full effect in January, leaving many of you looking for guidance on reporting requirements. Roger McEowen with the Washburn School of Law joins us now with all the details. Roger, thanks for joining us. Now, before we dig into that requirement, give us a little background on the CTA and its main objective.
Good to be with you, Tammy. The main objective is to enhance transparency in entity structures and combat basically money laundering and tax fraud and other illicit activities. It's trying to catch those people that create shell corporations to avoid tax, and it's designed to capture more information about the ownership of specific entities and income flows by those companies that are either in the United States or accessing the U.S. market.
Now, so who needs to report, though?
Well, this is a pretty broad sweep here. It's any entity that is created by filing a document with the Secretary of State or a similar office under state law. So that's going to pick up all your corporations and your partnerships and your LLCs, for instance. But there are 23 exemptions. It doesn't include a sole proprietorship, and there's an exemption for a business that has 20 or more full-time U.S. employees and reports at least $5 million on its latest filed tax return and is physically located in the U.S. But that's not going to exempt a whole bunch of farm operations. There's going to be farm and ranch operations beneath those thresholds. And even if the farming operation or the ranching operation were exempt, if they have other businesses such as an equipment LLC or a land LLC or any other related entity, they're going to have to file a report that details the required beneficial ownership information in that instance. Just having one large entity won't exempt the other entities.
So what must a beneficial owner do?
Well, a beneficial owner is somebody that who either individually or directly exercises substantial control over a reporting company or owns at least 25% of the ownership interest of that reporting company. And they have to report their name and their date of birth and their current residential or business street address and a unique identifying number from a recognized issuing jurisdiction and a photo ID of that document.
Now, before we wrap, there have been a significant number of fraudulent employee retention credit claims filed in the past year, and it's gotten so bad that the IRS stopped processing the claims for the fourth quarter of 2023. What is the latest on that situation, and what do we need to know?
Yeah, that's an absolute mess. I'm sure a lot of the viewers as well as listeners on Sirius side of things have experienced this, either gotten hit by their cell phone or they've gotten a call or they've gotten something in the mail of these mills that are trying to gin up these fraudulent credits. And I think some farmers thought that they might have legitimately been eligible for this, but you have to have a 20% reduction in gross revenue. And a lot of farmers didn't have that during the virus years. So now IRS, as you said, is not processing claims during the fourth quarter to try to get their arms around this. And now they've established an amnesty program. So if you think now that you actually made a fraudulent claim, you can withdraw the claim, no questions asked. And you can do that even if you're under audit. You just have to tell your examining agent that I'm withdrawing the claim. And even if you received the money but haven't cashed the check, you can send it back. No questions asked, no penalties. So it's a complete amnesty program.
All right, that is great information. That's Roger McEowen with the Washburn School of Law. Appreciate you joining us today, Roger.